Hello, welcome back to Laptop Trader Channel on YouTube. My name is Philip. I'll be hosting this presentation. Again, I'm here to share my trading experiences and give back to the stock trading and investing community one video at a time. This channel is mainly for new traders or new investors, but all are welcome. We publish a monthly video, sometimes two, to cover the markets, stock markets, and how to create confidence by putting the odds in your favor. If you wish to be updated when new videos are published, hit subscribe now. My email contact is laptoptraderphil@gmail.com if you have a question. This video is for information only and should not be considered investing advice. Caution: trade at your own risk. Most stock day traders lose money. Please protect yourself at all times. Any stock suggestions are up to you to decide if that is appropriate for you. Good luck and God bless. Invest in yourself. Start now by educating yourself on how markets work and finding out what is right for you. Invest in yourself, then invest in the markets. This video is going to be titled Get Ready Now for Future Success. This is going to be mainly for investors, but also does apply to stock traders. When you are educated and informed, then this builds confidence and removes fear of the stock market or investing. You are going to invest in something whether you like it or not. You can invest in not trying to get a return on your money. You can invest in things that go down in value, like cars and electronics, or you can invest in things that go up in value, like homes and stocks, or even investing in your family, right? You can invest in being a criminal or in being a good citizen. You can invest in being a blue-collar worker or a white-collar worker or owning a business. It's up to you. But we're going to cover the historical market activity and historical returns on investment. And I'm also going to highlight some more recent market context and perspective. I'm going to give you some 2026 expectations. And if this is a down year or an underperforming year, it's still a great time to get your finances and your seed capital in order. Be ready now for the next 3 to 5 years. You don't want to miss it. Stay the course. Work the 40-40 plan. That's work 40 hours a week for 40 years of your life and plan to invest 5 to 15% of your income. Start where you are at. Don't worry about what I can invest. Worry about what you can invest. Do your best, even if it's a $15 investment, and I'll prove that to you. Pay yourself first. The secret to investing is paying yourself first. Be disciplined and consistent in saving and investing every week, every month. Always be saving and investing. If you are a trader, there will always be opportunities, even in a down year or a down sector. So I don't want my traders to get discouraged by what I have to say. Let's look at Cardinal Health for an example that I put out there last month. Just look at the chart for yourself. Look at Cardinal Health over the last couple of years. Okay, and you'll see it outperformed the market and outperformed the overall healthcare sector. You just need to do the work to find the appropriate trade for yourself. Look at the market, then sectors, then industries, and then you can get an idea of where you want to trade or invest in individual stocks, whether by scanning or using software to help you out. Okay, so let's get ready. Let's prepare to be successful financially. Okay, and let's go to first, let's get some market context so we can all be on the same page. Okay, so here we have total returns of the S&P 500 index over the last several generations. This is going back to 1926, 1927. This website I find pretty helpful. It's free, stickcharts.com. Okay, and you can find this information on there. The only thing is you'll get pop-up ads, and I'll have to talk through those, but we'll just get through it. But everybody talks about back here in 1929, right? The Great Depression in 1929, and how that was the worst year. Well, it really wasn't the worst year. The worst year was actually 1931, where the market went down over 43%. There was also a very negative year in 1937, which nobody really talks about, where the market was down just over 35%. And so when we're looking at history, we need to look at all of history, not just one year. Everybody heard about or probably lived through the year 2008, right? The great financial crisis and the housing meltdown and the housing bubble. That year, the market lost 37%. But a lot of people didn't talk about the next 9 years where the market returned positive for the next 9 years straight. And then we had a down year in 2018, right? Minus 4% when we had the COVID crash. And then we had 2022 where we had a losing year of minus 18%. But if you haven't been in the market the last 3 years, you've left a lot of money on the table. Okay, last 3 years, 2023, return of over 26%. 2024, a return of over 25%. And 2025, a return of over 17%. Okay, so I'm thinking this year of 2026 could either be a down year or a year of underperformance like we had in 2015, where the market only returned 1.38%. Because if you look at this historically, you usually get 2 or 3 years of performance and then a down year or a year of underperformance, right? Here we had 2 years of performance and a down year. And then we had 3 years of performance and a year of underperformance. Then we had 2 years of performance and then a down year. And then we had 3 years, 3 great years, and then a down year. So we're at that point now where we've had, these 3 great years where we've, the historical return is 10 to 11%, and we're outperforming over the last 3 years. It's time for a year of underperformance or a down year. That's the only point I want to make, that be prepared if we have a down year or a year that just doesn't seem to go anywhere. But if you're an investor, you need to keep investing and stay the course, even if it is a down year. Okay? Let's get to something else when it comes to market context. And I'm going to use barchart.com for that. And here is a little more information for you about how the sectors perform over time. Okay, I'm going to go to a 10-year graph. This just showing the overall S&P 500 over 10-year period, last 10 years, up over 257%. The only sector to beat that over 10 years has been information technology overall, right, with a return of over 718%. All the other sectors did not outperform the S&P 500. Now, why is that important? Because if you stay the course and you invest through your employer or through, like a growth stock market mutual fund or an ETF or in a total market index fund or an S&P 500 index fund, you can kind of expect to have similar performance, right? But if you try to just go into individual sectors, you probably won't get that performance. So it's good to diversify if you're an investor and get involved either in an index fund or a market mutual fund or a growth stock mutual fund, because you want to be in the areas that are growing. Why else is this graph important? Well, it shows over this 10-year period what's underperformed: real estate, energy, consumer staples, utilities, and healthcare. These 5 areas are generally considered areas that underperform, but they're defensive. They're kind of safe, right? Everybody needs healthcare. Everybody needs, consumer staples, like food and toilet paper. And everybody needs utilities, right? Gas, water, and electricity. So these are safe areas, defensive areas. The other areas are considered growth areas, such as communications, financials, industrials, and information technology, and consumer discretionary. So these areas tend to lead to this outperformance of the index. Okay, so let's get to why that's important. When we look at these sectors on a graph, like this graph going left to right, this is over the last year. Okay, so I'm going to start unclicking some of this to highlight a point. I'm going to unclick what has underperformed, okay? And we're just going to leave the top 3 here over the last year, which I've already looked at. And those are communication services, information technology, and industrials have outperformed the market over the last year, okay, which is a really good year, right? Led by communication services, over 31%, information technology, almost 24%, and industrials, over 20%. And then the market here is the black line. Market overall, over 16%. So these areas outperformed last year. And currently, this communication services looks like it's kind of starting to roll over. And information technology has actually been on a bit of a downtrend since November. Meanwhile, industrials have actually been on this uptrend since November. So it looks like industrials are going to have a good year, or at least to start the year. And communication services may have a flat year. We don't know yet. But for sure, information technology has been selling off. I want to show you one more thing. Why I think this could be in a year of underperformance or even a down year is because what is performing right now going into 2026 are these defensive areas such as healthcare, energy, and consumer staples, okay, and materials, and industrials. Industrials tend to be one of the areas that does pretty good most of the time anyway, but so you can see, again, this black line is the market. These have underperformed, except for industrials, over the same period. But right now, the things that are pointing up going into 2026 is energy, healthcare, consumer staples, and materials, okay? These are defensive areas. Why is money rotating into defensive areas? Why are the growth areas not moving up still? But to start 2026, we're in a defensive climate. I think that's because of this overall expectation. The expectation that we've had 3 up years in a row, 3 really strong years, and I think the overall market expectation is that we're due for a pullback. We're due for a down year or a year of underperformance. So I think that's why we're seeing money rotate and move into these defensive areas such as materials, industrials, consumer staples, and energy. Okay. Again, this could change, but I just want you guys to be prepared for the overall market environment going into 2026. So let's look at a few more charts. So let's take a look at these charts very quickly, right? This is going to show monthly chart, right? Bitcoin did not have a good year in 2025, but that could reverse. It could go lower. We don't know yet. S&P 500, right? Big move up in 2025 since April. The market has basically been up for the last 9-10 months, starting to go sideways, right? So are we entering stage 3 into stage 4, or is this just going to turn out to be a base for the next move up? So either one is a possibility, but it's definitely extended up, and markets don't go up forever. Same thing with the NASDAQ ETF. Up since April, kind of had a down November, kind of break even sideways December, and now in January up just a little bit. So this looks also extended, and again, the 2 ways markets correct are over time and through price. So right now, so far, we're having this little time correction where we're just going sideways. We're due for a pullback, but that's not guaranteed. The one that's kind of outperformed recently has been the small cap Russell 2000 index, where that's making new highs. So that looks like a little bit of relative strength there. And again, the Dow Jones Industrials have also been very strong, but still making new highs, still an uptrend, right? So that's what I wanted to show you there. Again, we talked about stock market performance and some expectations surrounding that. And and we went over those ETFs, and we went over just the market sectors in general as a historical perspective, right? We've got your growth areas, and then you've got your defensive areas. And right now, money is moving into those defensive areas. So, if you're an investor, what would I do? Again, I would stay the course, because, let's talk about if you're a new investor, let's say you're 18, 20, 22 years old. I'm going to encourage you to work hard, save $1,000 for an initial investment or some initial capital, and then put away, $15 a month. That's where I came up with, $15 a week. That's where I came up with $65 a month for 52 weeks of investing. Let's say you've got 40 years to invest, right? From 18 plus 40, that'd be 58 to 60, 62, right? That would get you into retirement. Let's say you earn an average annual interest rate of 11%. And if we just compound that every month, we just keep investing every month, we hit calculate, we can see in 40 years, at only $15 a week, you could have over $600,000 for your nest egg. That's an awesome way to enter retirement. Okay. Let's say, again, these are just some initial numbers, but let's say you could put away, $25 a week. That comes out to be $108 per month, same amount of time, 40 years. We assume the same interest rate or return, and we hit calculate. What do we come up with then? Okay, so over a 40-year period, just by increasing your investment $10 a week, you could have over $1 million going into retirement. That would be a lot easier than working hard your whole life and not having any money in your investments. Let's say you don't believe in investing. You want to, maybe you're more of a artist, or maybe you want to go save animals or work with animals or something like that. You have no interest in investing. Well, I would kind of push back a little bit on that and say, couldn't you help more animals if you had $1 million or $600,000 to help the animals? Just by putting away a few dollars every week and maybe not going out to eat twice a week. So I think you're going to invest in something whether you like it or not. And even if you're not really an investor, I'm going to encourage you to become an investor, because for these reasons, right? The market tends to return over time, right? If you set aside some money now, you can expect to have some money in the future. If we go with, general market performance, you can see some sectors outperform and some sectors overperform. So it's important to be in a diversified fund like the S&P 500 fund, or a market index fund. And then let's get to, again, we talked about different sectors right now. We can go here to, 1 year. What's performed over the last year, again, has been communication services, information technology, and industrials. What's underperformed over the last year is financials, consumer staples, consumer discretionary, indicating a weak consumer, energy, and real estate. Okay, so we want to stick with the winners, but right now it looks like money is flowing into the other areas, indicating a potentially weak market. Now, let's talk about a possible idea for my traders. And I just found this by, just setting up a watch list of stocks that I've been following for some time based on performance. Okay. And let's just look at some charts real quick for my traders or investors. But this stock has been, over the last 5 years, right? This is a 5-year monthly chart. This stock pays a dividend. Rider system, symbol R. Nice uptrend over this time. And it looks like it just made a new high on a monthly basis in December. Looks like it's starting to kind of go sideways right now. But it looks like that could continue. So we're still in an uptrend on Ryder. That's a possible idea. We look this up. We look at something else, more of a technology company like Lyft. We see what? We see stage 4, stage 1, and we have kind of this breakout, but this breakout has been sold into over the last 4 months. Could this turn up and Lyft? It could, but it could also continue just sideways. So for me, I'd like to see Lyft get above this previous month here over 23.33 to see if that could start moving up. That'd be a one to watch. I look at something else like Vital Farms. I don't like the look of that chart as it's been selling off over the last 5 months, so that's a no for me. Something like Boston Scientific, BSX, looks like a pretty clear stage 3 into the stage 4. So for me, that would be a no as a trade or investment. So I'm just using these charts to come up with these quick ideas. BOSC stands for BOS Better Online. I don't like that large wide range red bar there. Esquire Financial, this looks like a pretty steady uptrend until this month where it spiked up but then was sold into. This would be one to watch. I would like this over 110.71. Yeah. So let's say over for even numbers over 110. I would like this. Right now it closed this week at 107.69. I don't like that topping tail, but if that could get moving up again, that's a possible idea. IBEX is kind of forming a kind of interesting pattern here where it made a big move up, 37% in a month and then pull back, and looks like that could potentially get going again, but it would have to get over this red candle over 40.78, over 41 to be safe. But that's kind of extended, so that's probably not the best idea. This looks really good, Guardant Health. You can clearly see the stage 4, stage 1, and then this early stage 2. Looks like we have a nice consolidation here over the last 3 months. That looks like that's getting ready to keep consolidating and, looking for that next move up. That's a possible idea. How about this one, VSEC Corp? Just had a breakout this month. That looks really good going forward. Let's see what else we got. AMRX, pharmaceutical company. It's kind of extended up over the last 5-6 months. IMAX company looks more of a kind of the end of the move where we've got these wide range bars at the top there. I don't like that. But then I came across this Wayfair. Okay, so what do I like about Wayfair? Well, you can see the stage 3, then the sell-off in the stage 4. This long stage 1 since 2022, mid 2022, all-time low in April 25. Then what happened? Then it went up with the market. Okay, so I like that. This stock is up significantly since April of 25, where it closed at 30, and it closed this week at 118.78. That's very significant. But the thing I like about this chart is it looks to me like it's got a long way to go. A lot of area up here to move into, indicating, there's really no selling pressure on this stock. I like that it's outperformed the market. Okay, if I eliminate these moving averages and I put in a comparison on this, I can compare other symbols. So we can compare this S&P 500 and we can compare the NASDAQ to this stock directly on the chart. And over the 5-year period, these indexes have outperformed this stock. But when we look at more recently, like over the last year or two, if we change this to a weekly chart over a 2-year period, the stock itself is actually outperforming the market. So that's the other thing I really like about this individual stock. Wayfair symbol W is over a 2-year period, markets returned 44%, but Wayfair has returned over 110%, showing what? Relative strength outperformance. So I like Wayfair to continue that trend here in 2026 as a possible trade idea for you guys. Okay, so I'm going to end the video here so it doesn't get too long. But if you do your homework, you can increase your confidence, put the odds in your favor, come up with some good stock ideas. If you don't want to trade individual stocks, that's awesome. You should still invest. Invest in a mutual fund, a growth stock mutual fund, a market index fund, or something like that, so that you can have some money for the future. Okay, so we're going to end it there. Thanks for watching, subscribing, and sharing this channel. And I hope you have a great 2026. And we'll see you in February for our next market video. Good luck.